Here's the thing about gold next year. I think it could see 5,000 and 3,500. It could do both. Typical kind of year like this is what it's done. Every time it could do both. The key thing is it's unlikely to stay above 5,000. And maybe here's the key thing. Maybe it'll meet the S&P 500 at 5,000.
Interesting. And Bitcoin back to 100,000? I mean, I saw a call of yours to almost 40.
I think it's going next year 50 and eventually on its way to 10,000. This the same call I made in 2008 when it went above 10,000. Same thing when it been above 100,000. I think it's going to lop off zero. So I think the first key level is 50,000. Copper is the number one that matters next year. So I want to just tilt over copper a little bit, and that is the price right now about $5.40 is, we've reached record highs. And I'm using U.S. based copper. If the stock market just has a little bit of backup, copper can easily get back to $4.50 easily.
Mike McGlone outlines why 2026 could deliver extreme two-way volatility across gold, Bitcoin, and copper as markets approach major inflection points. Gold could experience a dramatic V-shaped year, potentially reaching as high as $5,000 while also revisiting levels near $3,500. While a spike toward 5,000 is possible, McGlone cautions that it is unlikely gold will hold those levels for long. One notable scenario is gold briefly meeting the S&P 500 around the 5,000 mark before retracing. Bitcoin faces similar volatility. McGlone sees a key level near 50,000 with downside risk toward 10,000 if a traditional bear market unfolds in equities. Longer term, however, he maintains a structural bullish view, suggesting Bitcoin could eventually lop off a zero, echoing past cycles. Copper, meanwhile, may be the most important signal for the global economy. Trading near $5.40 copper could easily pull back to $4.50 if equities soften, making it a critical barometer to watch. Now, we present the clips from Mike McGlone's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
More of an industrial metal every day. Now, industrial demand is great. But let's think about what's happening in China. They're facing pretty significant headwinds from the rest of the world pushing back on their exports, which are no longer going to the U.S. Major deflationary forces out of China. To me, the bottom line for silver and industrial metals is just look over what's happening in things like iron ore going down. The world's most significant industrial commodity, crude oil, going down. And then what's the number one measure, I think, of inflation or deflation in China? Just look at their bond yields, 1.84% on their 10-year note. That's a sign of pretty severe deflation. I don't see a shift in that anytime soon, but I do see a major burden on U.S. stock market staying up just for what's happened this year in the industrial metals to stay resilient. Here's the thing about gold next year. I think it could see 5,000 and 3,500. It could do both. Typical kind of year like this is what it's done. Every time it could do both. The key thing is it's unlikely to stay above 5,000. And maybe here's the key thing. Maybe it'll meet the S&P 500 at 5,000.
Interesting. And Bitcoin back to 100,000? I mean, I saw a call of yours to almost 40.
I think it's going next year 50 and eventually on its way to 10,000. This the same call I made in 2008 when it went above 10,000 that it's going to lop off a zero. That was 70% right and 30% wrong. The low was 3,000. Same thing when it been above 100,000. I think it's going to lop off a zero. So I think the first key level is 50,000. And if I'm right about a normal bear market in the stock market, Bitcoin's going to get to 10.
Wow. All right. And finally, I mean, you kind of brought it up there, but U.S. 10-year Treasury yield, I mean, 3%?
Yeah, or lower. I think it's right now just about 4%. I think it's much later to go to 3 or lower than stay above 5. And the key thing is that long bond. That long bond has popped up. The high this year is on 5.15%. That was a key level for almost 25 years ago. I think it's more likely to drop with a normal backup in U.S. risk assets, which means the stock market. So U.S. stock market, S&P 500 having a normal 20% correction. If it does that, copper typically drops 30%, easy, maybe 40%. Now, if that's my point, it cannot do that if you're bullish copper. And that's why I point out is we all have supply and demand models. Most people are pointing to deficits, but we've already popped up in price, which means things will adjust. Obviously not as quickly as things like grains, but the bottom line for me for everything, Jeremy, when I get stock market volatility this low, and most indications are that it's potentially going to roll over next year for other markets, that's the number one, that's the 10 on all that matters. So anybody who's running a value at risk model and sitting at positions that are long industrial metals, or even looking to buy things like industrial commodities like crude oil, number one thing you need for bullishness for next year is you need the stock market to go up. And if it drops, we're going to have a correction. We're going to get that 120-day volatility back to 17% at some point. It always goes there. I think U.S. Treasury bond yields, the long bond, or let's use a 10-year note, right now to 4.14% is more likely to head towards what's the case in China. at 1.84%. I started in the bond futures pit in 1988 in Chicago, trading pits. I thought I knew that market the best. I've been wrong on that one for a couple of years now. To me, that's the next big trade, and all the dominoes are there. And the next catalyst is just a little bit of backup in U.S. stock market. That's what's elevating inflation and keeping CPI elevated and pushing back in the Fed and everything. Is just a little 20% correction in the U.S. Treasury and it's in stock market, and it stays down for a little while. I think that 10-year note yield right now at 4% is going to drop below 3.
Oh wow!
But so that to me is the next big trade. But here's a key problem. So I've been, I have to admit, I've been not a big fan of stock market forever, but I found great beta in Bitcoin and gold. Yeah. I jumped off the Bitcoin horse last year, just when I viewed as, supposed to be selling when they're yelling, and I'm somewhat jumping off the gold horse this year because it's a very extreme market, and so that's why the only thing I have left is Treasury bond world. So if you take the S&P 500 divided by the MSCI World ex-US Index, the dollar index has been in the same trade since 2009, and they both come down this year. So the U.S. stock market continues to underperform its peers in the rest of the world. I think that's going to be the same thing for the dollar. And the key thing from a U.S. standpoint, and what I've heard from some wealthy money managers, is when you've accumulated so much wealth in dollars and assets, it's best to diversify them. Now, whether that's gold or the assets outside the U.S.
Mike McGlone argues that 2026 could mark a turning point for global markets as deflationary forces from China collide with stretched U.S. asset prices and unusually low volatility. Despite strong industrial demand narratives, McGlone points to falling prices in crude oil and other key commodities as warning signs. China's 10-year bond yield near 1.84% signals deep deflationary pressure with no clear reversal in sight. If the S&P 500 experiences a typical 20% correction, copper could easily fall 30 to 40%, challenging bullish supply deficit assumptions. Gold may see extreme volatility, potentially trading as high as 5,000 and as low as 3,500 in a single year, while Bitcoin's next critical level sits near $50,000, with downside risk if equities weaken. For McGlone, everything hinges on U.S. stocks. A sustained pullback could push Treasury yields sharply lower, possibly driving the 10-year below 3%. In that environment, diversification away from U.S. assets becomes increasingly important. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos.